Okay, perfect. Thanks, guys. So, what I've done here is what I call the cash flow offset, and I'm using it with the brand new launch of York Towns. So, York Towns is a brand new development going up in Calgary, and um, just one second. Thanks, Fred. So, this is the cash flow offset model. It's a brand new development going up in Calgary. These are townhomes. They're going to be completed in in summer 2022, and you're able to purchase them with 5% down now and 5% down in 90 days. But the great thing is they come with a 3-year rental guarantee that provides significant cash flow. Over $350 and in some instances over $400. And I'm going to show you something incredibly cool, which I'm calling the cash flow offset model. But first of all, some additional information on myself. I'm the owner and broker of record at Remax Wealth Builders Real Estate. I've been selling real estate in Toronto for over 12 years. Number one Remax agent in Ontario for individual transactions 2019. Number 13 Remax agent in Canada in 2020, number 34 agent worldwide in 2020. Been inducted in the Remax Hall of Fame and awarded the Remax Lifetime Achievement Award, but none of that matters to this. What really comes down to is what I'm preaching is the investment side, and that's turning a small deposit into a $14 million portfolio, which includes 14 condos, a High Park triplex, and an apartment building in Hamilton. And I started this journey in 2019 investing in Calgary, but I started in Toronto in 2012. And that's where I could get similar pricing to what I'm seeing in Calgary. So what I've done and what I wanted to show everyone is how I turned that small deposit into a $14 million portfolio, which we see here. This is everything I own in my portfolio. But then I spread it out over 30 years, and that's where real estate really gets powerful. It's the actual time aspect of real estate, because the beauty is that someone else is paying the expenses for everything in the property while I own it. They're paying rent. They're covering my mortgage. They're covering my maintenance fee. They're covering my property taxes. And in this case, we're getting excess cash flow. And that's how I built everything, with excess cash flow. The first Carnaby condo, which I purchased here in 2012, I bought that condo for $260 some thousand. And then when I got the property, I took money out of that property, used the excess cash flow in the property to cover the interest expenses, and then I bought more property, and that's how I built that portfolio. But I can't do that anymore in Toronto. I don't have excess cash flow, and that's where Calgary comes into play. And then when I look at this beautiful portfolio here, in 30 years, the value is going to be $36 million, and I'll own it outright because there's been a tenant in the property the entire time paying down all these properties. Not my money, but other people's money. And because my background's in economics and finance, we hear about that word inflation. So I want to adjust this and put it in a today's value term. So what's my purchasing power in today's dollars? Well, this would be the equivalent of nearly $21 million. So I'll have a purchasing power of $21 million in the future by, again, owning this portfolio and having people pay it off. And what does that mean? Well, if I take that value and I apply just a simple 5% return, so I'm looking to generate 5% on the value of all the assets, I'll generate an annual income of over $1 million off of that portfolio. And if I want to reinvest 2% of that to protect against inflation, it'll generate nearly $625,000 annually for me. And because I'm protecting against inflation, that means I have now built generational wealth that I can pass on to my children and future generations, because it's fully protected against inflation, and it's continuing to go up in value. And where that, now I have this chart on here just to show that anyone can do it. the $14 million could seem daunting to people. Like, oh, how am I going to build a $14 million portfolio? You don't need to build a $14 million portfolio. If you have a $1 million portfolio today, that in 30 years will provide a $70,000 annual payout to you in 2030 in 30 years, adjusted with today's purchasing power. So if you have $1 million worth of real estate today, that you can have $70,000 annual payout in 30 years, or if you want to protect against inflation, $42,000. And this is where it gets extremely exciting. So I want to use the funds. This is what you can do. You can use the funds from your home. You know how we hear those radio commercials where you own your home, approved, own your own home, approved. Well, that we're not quite saying that in this one, but if you own your home, I can show you now how you can use that to build your own pension fund. So you're not relying on your home, which some people do, going, oh, I'll just sell my house in the future and I'm going to live off of those funds. Well, if you sell your house, you still need somewhere to live. So with this method, you can keep your home in retirement, leverage existing equity now to fund your retirement. So the issue is great, your house went up in value, but what's your rate of return on that? Well, it's zero, because you're not reinvesting it somewhere. So I can show you how you can leverage equity out of the house. So the only way to get equity out of the house is you sell the house, or if you borrow money against the house and invest it somewhere. So I'm going to show you how to leverage the existing equity in your house to fund your retirement. And each one of these townhomes will represent $23,000 of annual income in your retirement years. And I'm going to show you how right now. So first of all, let's show you how you can own your home and use it to buy a condo. So if we look at if you're buying one of these townhomes, so one of these townhomes, the lowest price townhome is $340,000, including GST. So you take a home equity line of credit out. So when you get the property in 2022, you'll still have to put 20% down. You only need to put 10% over the next 90 days in 2021. But in summer 2022, you'll come up with an additional 10%, because that's what the bank's going to require for a mortgage. So if we look at, you're going to take a loan out of $67,980 against your current house. The monthly interest on that, what it's going to cost you to carry that, is $167 per month, which we see here. Now, your York condo, your 2-bedroom townhouse over 1,000 square feet, as I said, the price on that is $340,000. The mortgage on that will be $978 per month. The maintenance fee, very small maintenance fee on that to cover landscaping and road maintenance, $135 per month. Property tax, $130 per month. The monthly cost, $1,243 per month. But you're going to get $1,800 a month in rent on that property. So that means it's going to cash flow $557 per month, plus you're paying down the principal every month of $575. So your cash flow and your principal payback, so paying down the mortgage every month, that tenant paying down the mortgage, so in 30 years you own that property outright, you're generating over $1,100 per month of savings in that house. And remember, you haven't put a dime in this property. You only leveraged the equity out of your current house. And when we look at the math, let's look at that. So your interest expense is $167. That's for the down payment for the townhome that you took off of a line of credit off your current house. The cash flow on the townhomes are $575 per month. Your combined cash flow between the two is still $407 per month, positive cash flow. So again, none of your own money has been used. You've just leveraged the increase in value of your current house. You've leveraged that and purchased another asset, and that's providing you still of additional cash flow of $407 per month. Now, this is where I get excited. So let's look at the value in 30 years. Well, if we just assume an annual compounded interest rate of 3% per year. That's it. I'm not putting crazy numbers in here, just 3% growth per year. And I adjust that for inflation. So today's purchasing power. So it'll be worth $825,000 in 30 years. In today's dollars, that's $472,000. And if I apply a 5% rate of return on that, that means I can get an annual income of over $23,000 per month. Not per month, $23,000 per year from that property. $23,000 per year for buying that one condo using money, which has now been paid off from your current house. Not a dime used, just using appreciation in the real estate market. And you've set up an additional income stream for your retirement in 30 years of $23,000 annually. And now this is where it gets even crazier. So let's say, and this is actually a objection I get a lot. And people are like, well, Alex, I want a condo in Toronto, but it's going to be cash flow negative. And I'm like, absolutely. The days of getting cash flow positive condos in downtown Toronto are over. You can't invest with only 20% down and get a cash flow positive condo. It's not going to happen. But I can make it cash flow positive with the cash flow offset being a York townhome. So I picked a brand new development here. It's being developed in downtown Toronto, prime condos. It's going to be completing in early 2024. So a one-bedroom unit there will cost $691,000. So basically $692,000. The mortgage on that will be just under $2,000. Then you have your maintenance fee of $281, your property tax of $352. So your total carrying cost of the unit is $2,625. But the expected rent on that, $2,200 per month. So that means the cash flow will be negative. You're going to be negative $425 per month. That means out of your pocket every month will come $425. You will be paying down additional principal of $1,170. So you're still in the positive in regards to a growth level, but out of your pocket, a cash flow will be negative $425. But if we also purchase a York town, so you purchase a York town, which, as we discussed, will provide you with $557 per month of positive cash flow, which we went through in the last example. Let's see what happens. So I have my Toronto condo, which is providing me with negative cash flow of $425 per month. But I've offset that with an investment in a cash flow positive property, which is a York town. That's $575. The combined cash flow of those two properties is positive $149 per month. So just $150 per month, you're going to be positive cash flow. And you now own a Toronto condo and you have your York town. And what does this do for my retirement? So now I have two properties. So I have my York town. That's going to be $825,000. I'll have my condo in 30 years. It'll be worth, in downtown Toronto, be worth $1.68 million. So after I adjust for inflation, that total value would be $1.432 million. And what annual rate of return am I going to get on that? Well, that's going to get me over $70,000 per month annually at a 5% rate of return. So I've been able to invest in a downtown condo, but I've protected myself with the cash flow from a property in my portfolio that has significant cash flow. And combining the two, now I'm able to have positive cash flow and have a property in downtown Toronto that's going up in value, and a property in Calgary, which I also expect to go up in value, but I'm rewarded with the cash flow on that. And what I'm going to go now into is why I see positive opportunity in Calgary and why I've been buying in Calgary. Yes, anyone that has questions, just put it in the Q&A box, and at the end of this presentation, I'll be answering any questions. So why Calgary? It's the most livable city in North America for the last 2 years, the most livable city in the world. for fourth most livable city in the world, top 5 on the Economist Intelligent Unit's Global Livability Index. It's located in the foothills of the Canadian Rockies, loads of green spaces, and the second lowest cost of living of Canadian cities, and the 9th lowest in North America. So when I started looking in 2019, these were things I'm like, okay, this is worth my research into this market. It's also things I found out: the sunniest city in Canada with an average of 2,300 sun-filled hours per year, the most extensive outdoor path network, and ranked the second for healthiest lifestyle and life satisfaction of major cities in Canada. So seems like a good place to live. So click those check boxes. So then I did more research into Calgary. Just outside of Calgary, we have Banff National Park, 5 world-class ski resorts, over 200 hiking trails in the national park, and it's only an hour and a half drive away. Only an hour and a half drive to get to one of the most world-renowned national parks there is. It's a huge benefit. And when I say a 1.5-hour drive, this is not like where I need to leave at 4 a.m. to get to Muskoka in 2 hours. It's only an hour and a half drive to get to Banff. So why? So other those facts, what numbers behind the scenes did I see upside? Well, the population. The population is growing. It has a positive population growth. The Calgary market. So, number one, we're in the business of investing in roofs over heads. So I want to see that the population is growing. Number two, Calgary has the highest millionaires per capita of all major Canadian cities. Also, Calgary represents the highest wages and salaries per employee in the country at $66,000, and that was done in 2018. So I have positive population growth, so the population's growing, and also I have high wages to pay for the rent and also to purchase properties. So when I look at the population growth, this is where things got really exciting. So Alberta is set to lead the country with 48% population growth versus 24% in Ontario. So Alberta is going to lead Canada in population growth and will be larger by BC in 2 decades. So BC, its population is currently 600,000 less than Alberta. By 2043, so 2 decades, Alberta will have 400,000 more people. So I'm growing at twice the population growth rate of Ontario. And my other neighboring province, BC, I'm going to have a net population swing of over 1 million people. So again, if I'm investing in roofs over heads, I want to go where the population is growing the fastest, and that is Alberta. And then in regards to money, we look at economic output. So Toronto, Montreal, Vancouver, those are your big 3 that we know for population and also for economic output. And then number 4 is Calgary. So I have my population growth, and I have, in regards to it, economics, the money is also in Calgary, as we discussed. It has the highest wages in Canada, highest per capita millionaires in Canada, and also the 4th largest economy in Canada. We know what's happening with real estate prices in Toronto. We know what's happened in real estate prices in Vancouver. And we recently, over the past probably about 5 years, we've seen significant growth in real estate prices in Montreal. Calgary will be next. And just to put in perspective the size of the economy of Calgary, its economy is larger. The city of Calgary's economy is larger than the whole economy of Saskatchewan and the whole economy of Manitoba. There are significant economic forces that work in Calgary. So we're doing something different in Calgary versus what we've traditionally done in Toronto. So Toronto, as you can see, I have significant holdings in Toronto when I went through my portfolio at the beginning. We've kind of been riding the ladder up. And I have no worries about the Toronto market or the GTA market. Markets outside of the GTA I definitely have some concerns about. But the GTA I have no concerns about. And we're going to continue to see values rise here. But my cash flow does not work anymore. The rental numbers do not work anymore. So I went to a market where the prices have been suppressed, and the reason they've been suppressed is you had the bottom fall out of the oil market in 2017, but all of those layoffs have been complete. Layoffs have been done. Business closures have been done. So we're buying low in the market, and now we're going to profit off the recovery of the Calgary market, and we're going to see prices increase, and we're not wholly relying on oil and gas, which we're going to get more into in this presentation. So I put this nice little line here. Anyone that's watched this webinar before on why Calgary knows I give this line, Warren Buffett, big proponent of buying low, selling high. That's why I made this quote. And I also add the quote that he recently bought a pipeline himself for $9.7 billion. He did that last year. So we're buying low. Well, new condo sale prices have dropped 21% since 2017. So we've seen a dip in the pricing. We've seen the prices go down. That's when we want to buy. We look at the metrics. We know Alberta is the fastest growing province in Canada over the next two decades. And we're going to go over the economic stats soon. So we're buying low because we know there's going to be an upside of recovery. In regards to oil and gas, which we're going to go in detail talking about how relying it on the backbone, but I want to get a little bit into, because people always ask about Trans Mountain Pipeline. Sorry, not Trans Mountain Pipeline. People ask about Keystone. Keystone doesn't matter because Trans Mountain is the one that you want. Trans Mountain is under construction. Trans Mountain is owned by Canadians. Trans Mountain is going to increase our oil exports by 13%. Trans Mountain is going to increase our exports to international markets. So the issue's been with Alberta oil is that it's landlocked. There's no way to get it out of Alberta other by rail, pipeline, or in tanker trucks. So the majority of oil actually gets sent to the U.S. And so Keystone was just going to increase the supply of oil to the U.S., but they're the ones that have the monopoly on our oil exports. And that's where we can have instances where Alberta oil will sell at a significant discount to the worldwide oil price because we're basically a sole source customer to the U.S. with our oil. We can't reach the international markets, which are the markets that are actually growing for oil. Now, Keystone, which is going to increase exports to our main customer, which doesn't really impact the value of our actual worldwide oil price. And the capacity for oil going to the U.S., we already have the capacity to send oil to the U.S. That we have enough capacity to send it, because what happened is Keystone was already canceled once in 2015 by the Obama administration. Because it was canceled, other pipelines made efforts to increase their capacity. So we have enough capacity in our pipeline system already to service the current needs and future needs of the American population. It's the Trans Mountain Pipeline, which is going to increase our international exports, which will allow us to broaden our customer base and to allow us to sell our oil at a higher price closer to the worldwide oil price. That's what you care about. That's the distribution issue in regards to oil and gas in Calgary. But that is being fixed because Trans Mountain Pipeline is scheduled to complete in 2023. That is being taken care of. But let's talk about the diversification. So oil and gas were the driver of the economy before 2017 in Calgary. Then you had the price of oil fall out of the market, and that led to layoffs. As I said, those are all done. That's been taken care of. Well, what did it do, though? It built this beautiful infrastructure in Calgary. So you have this huge infrastructure that is built on the backbone of oil and gas. So that revenue is always going to be there. There's a segment of that revenue that'll always be there. And Calgary is still going to be the national leader and striving to be a worldwide leader in certain areas. But they will focus on energy financing and energy development. You'll always have that sector in Calgary, and you rely on that sector to bring in a portion of the income. But what you have now is this backbone, and what's happening in all of this other space that's in Calgary. Well, Calgary is ranked in the global top 10 most attractive cities for workers. Calgary has the highest proportion of STEM graduates. That's degrees in programs in science, technology, engineering, mathematics. Key, which we're going to get into very shortly, key for the tech sector, and low-cost office space at 27% vacancy. You had to overbuild happen when oil was $100 per barrel. So you had all this office space being developed. So now you have all this vacant office space, this brand new office space. Well, who's going to move in there? Well, now you have low cost office space. And what you're going to have is you're going to have technology companies move in. So Calgary is home to 435 technology companies, and 3/4 of these are startups. There are more than 2,000 open tech jobs in the city, and there's a record 44,500 Calgarians working in tech right now. So you have this beautiful backbone that was built by oil and gas, but you're going to have a diversification of the economy moving in the tech sector, which is happening right now, which I'm going to give you examples of right now. So if we look at how low cost is this office space? Well, the average office space in Calgary is $17.50 per square foot. Compare that to Edmonton. Edmonton is 23% more. Compare that to Toronto, it's over 100% more. So double the cost for office space in Toronto. And in Vancouver, it's over triple, 155% more office space. So I have low cost, affordable office space, which allows companies to reduce their cost base and operate in Calgary. And what have these companies been doing? Well, you have the startups. As I said, 435 technology companies in Calgary currently and only growing. And it's a great incubator for new startup technologies. So there are unicorns coming out of Calgary. So unicorns are companies that reach $1 billion valuation. So Benevity, this is the recent company that hit unicorn status. You can see this article came out in December 2020, $1.1 billion. They sold a majority stake in their company. Homegrown Calgary success story. And just looking at some other success stories in there, you had Solium Capital, which is sold to Morgan Stanley for $1.1 billion in 2019. Then you had Parvus Therapeutics, that was sold to a San Francisco-based biotechnology company that same year. And you also had, as I said, Benevity, which recently hit unicorn status. And then we looked at it here. Calgary is now punching above its weight when it comes to attracting investment capital and high value deals. What happens is, okay, so venture capitalists are looking, oh, hey, $1 billion deal, $1 billion deal, $1 billion deal. I want to get in on the next $1 billion deal. So what's going on in this market? There seems to be a lot of high returns coming out of this area. Okay, Calgary. Okay, let me start knocking on these other startups' doors and see if I can invest capital. And then also you get the founders of those initial companies, which have gotten huge payouts from their companies hitting unicorn status. Well, they start reinvesting in their market. They see their friend going, hey, my friend over there, he has a great idea. I'm gonna invest in his startup because I just got a windfall from mine. I'm gonna give him some guidance, and that's where you get the incubator gets larger and larger and larger, and then you start developing a whole new infrastructure and industry, and that diversification is happening in Calgary. Give you some more examples of this. These are companies that are moving into the downtown core of Calgary as we speak. So SciMed had 20 employees in the spring of 2019. Today has more than 200 employees. They just signed a 79,000 square foot lease in downtown Calgary, and they're looking to hire another 200 to 300 people in 2021. Halcyon, they went from 3 staff 5 years ago. Now they're at 68. They plan to bring in another 150 employees by the end of 2021. They're signing a lease for 20,000 square feet in downtown Calgary. These are all homegrown success stories. We have LodgeLink will require 300 new technology-based jobs over the next 5 years in Calgary. They're also hiring another 300 individuals in Calgary, and they'll require an additional 50,000 square feet of office space in Calgary over the next 5 years. But it's not just homegrown. Now we have international companies that are looking at Calgary. So CloudExa was the first one. They're a software development company with headquarters in Silicon Valley, India, Mexico, Singapore, and the United Kingdom. They looked all across Canada. They chose Calgary as the place that they want to open their Canadian head office. So we have international companies that are looking at Calgary going, A, we can get low-cost office space. B, we have great talent there, the highest percentage of STEM graduates in Canada. Plus, you have the youngest workforce in Canada in Alberta. And oh, by the way, which we haven't got into yet, Calgary has the lowest corporate tax rate in Canada, as well as there's no provincial sales tax in Alberta. So low cost and tax environment, low cost operating environment due to low cost office space, and a great pool of workers to select from. So now you have the international companies going there. Infoseed. This just happened March 2021. Infoseed, huge multinational company announcing they're going to be opening a Canadian head office in Calgary, and they're going to be 500 jobs in Calgary. And this just happened last week. Emphasis is an India-based IT solutions provider, and they're going to set up their Canadian head office in Calgary, and they're going to hire another 1,000 new tech workers over the next 2 years in Calgary. So it's happening. And how do I know it's going to continue happening? Well, because I've already seen that happen somewhere else. So when I looked at California to Texas, so you're seeing an exodus from California to Texas and companies setting up in Texas. Why are they doing that? Well, they're fleeing high taxes. They want more affordable housing for their employees and government regulations. Okay, well, when I look at Alberta, well, Alberta has the lowest corporate tax rate in Canada, so check mark there. There's no land transfer tax or development charges for investors, check there. And there's no provincial sales tax. So Alberta has the most favorable tax environment in Canada. Number 2, expensive housing. Well, we all know California has incredibly expensive housing, very similar to our Vancouver and Toronto markets. Well, we know that Calgary has the second lowest cost of living in all major Canadian cities and 9th lowest in North America. So I have low taxes, lowest corporate taxes in Canada. I have some of the lowest cost of living in Canada for major Canadian cities in Calgary. And then government regulations. Well, the government is pro-diversification of the Alberta economy. And we're going to get into why they can make those investments, because I'm going to show you what their net debt per capita is. So they recently invested $175 million to the Alberta Enterprise Corp for innovation. And there's no rent control in Alberta either, which is very favorable to real estate investors. So to give you an idea of some of the companies that I've seen leave California and move to Texas, we have HP, we have Oracle, we have Tesla, we have Dropbox. All these companies are now establishing a presence in Texas, and in some cases, their CEOs and founders have moved to Texas away from California to take advantage of the low taxes and more affordable living costs for their employees. So I could either have my employees sleeping on a couch in San Francisco, or I can actually get them some appropriate accommodations for them to live in. And if my employees are not worried about where they're going to be living next month, they're living comfortably, they'll be more focused on the job at hand. And that's going to be very attractive for companies for looking at their workforce. And I love this slide. I absolutely love this slide. So, I made the comment about Alberta investing in diversification. Well, why can they do that? We beat the drum on talking about oil and gas being the backbone. So the growth in Alberta, the wealth of Alberta was built on the back of oil and gas. Because of that, they have an extremely low amount of debt. Per capita, by far the lowest in Canada, less than $2,500 per individual, versus the rest of Canada, which has a per capita debt of over $10,000. And if we look at Ontario, it's over $18,000. So Alberta, which will now, if you do any research, will have the fastest growing net financial debt per Canada. But that's because they saved their money. And now they're like, okay, well, now's the time to spend. We are going to spend. We're going to welcome these international companies in. We're going to provide an attractive environment by maintaining the lowest corporate tax rate in Canada. We don't have any provincial sales tax. So let's make investments in our economy to attract businesses, to attract workers, and to attract economic activity. So Alberta, pro-investment community, no rent control, no foreign buyer tax. So when we look at Vancouver and the greater Vancouver area, when we look at Toronto and the Greater Toronto area. But just to give you an idea here, no rent control, no foreign buyer tax, no land transfer tax, no provincial sales tax, no development charges, and there's a $10 billion stimulus package, including reducing corporate taxes, happening in Alberta right now. And to give you an idea how quickly these projects sell, and again, I think this might be cut off for you, but Era sold out. We sold out 180 units in 3 months in November 2019. Era 2 was another project. We sold out 40 units in 2 weeks starting March 2021. East Hills Phase 1, 87 units in 2 weeks in 2020. East Hills Phase 2 sold out 184 units in 2 weeks in May 2021. So that just finished up. So there is a strong eagerness for people that are investing, and we're seeing investors come from British Columbia. We're seeing investors coming from Ontario that are taking advantage of the cash flow in the Calgary market, because we can get that significant cash flow. That's the presentation there. So I'm just going to stop that now. So to give everyone an idea, now we have the York towns, which are range from over 1,000 square feet to nearly 1,500 square feet. 2 bedrooms plus den. 2 bedrooms, 3 bedrooms, 3 bedroom plus den, which could be converted to a 4 bedroom, and those are ranging from $340,000 to $390,000. And as I said, the cash flow on those will be $350 per month or higher, which will allow you to do that cash flow offset. So where I said you could buy a property and with none of your own money, with just your home equity line of credit from your house, and it'll pay everything off. So what I'm going to do is I'm going to open it up to the Q&A for people that'll have questions here. Okay, so if anyone has any questions, then put it in the Q&A box. So what it is the York towns. Okay, so question: what happens in 3 years if no rental? Well, the current market rents in the property are what they're offering on the rental guarantee. Same thing would happen if in Toronto at one point your tenant's going to leave, so you'll just re-rent it out in 3 years, and that rent, you can expect rental growth during that period. There is no rent control in Alberta. So let's say it's $1,800 right now for the 2 bedroom unit. That's $340,000. That there, you could expect that unit to rent for over $2,000 in 3 years, providing you with even more cash flow and offsetting any potential additional costs that be on the property. So Ricky, what's a deposit structure? Yes, only 10% till occupancy. It's only 10% deposit until occupancy for the Yorktown. So again, all this information will be sent in a detailed email to everyone on the property. Victor, yes, the location is in Northeast Calgary. That specific location will be shared in the email that goes out. So it's in Northeast Calgary. The builder is Truman Homes. So Truman Homes, one of the top builders in Calgary, very high quality product that's going to be coming with the development of the site. So you would basically, what happens is you sign the contract. We only have 20 of these. You sign the contract this year, and in summer 2022 you'd get the property. Now there is no occupancy in Alberta. So from day one, when you close on the property, you'll be paid rent right away. So you, from day one, when you get keys to the property, you're going to be getting that significant cash flow for it. Just looking at the Q&A, if there's any other questions here. So as I said, the York towns, I love the concept of the cash flow offset, whether you're looking to invest in a condo downtown Toronto and use this to offset the negative cash flow, or if you just want to invest in your retirement and you leverage the equity in your current house and you use the positive cash flow to pay off the expense of the down payment from your house, and then you just sit back, and the place will pay for itself over the next 30 years, and then in 30 years you're going to be generating $23,000 annually from this property. It's a third party company that handles all the rentals for Truman Homes in Calgary. Yes, assignment is available. Someone asking if there's an assignment. Yes, assignment is available. And yes, just to clarify, from day one, the property will be rented. From day one, you'll have zero vacancy for 3 years. Every day, let's say it's the first of the month, every first of the month, you're going to be getting your rent check from the property. Okay. Someone wants to know what a 3-year rental guarantee is in detail. What it is, it's actually a lease back by the builder. So the builder will be your tenant. Builder will be your tenant, and then from every month, you're going to be getting that $1,800, or for some instances, $1,900, or other instances, $1,950, depending on the unit type you go for. So from day one, you're going to be getting that cent rental amount. Then the builder is going to be renting out the unit. They're going to go and they're basically taking the liability of the unit being vacant. They're like, you know what, don't worry about it. We'll take the liability of the unit potentially being vacant. We're going to just give you the monthly amount, and then they're going to go rent it out. And also, it's going to include the full management of the property as well. So you have no management expense over the first 3 years because the builder is managing the tenant. You're not handling the tenant. So you get the rental guarantee every month. You're getting the guaranteed rent, and you don't need to deal with oh yes, I love LJ probably raised his hand about 25 times, and LJ got it. That's right, there's no risk. So here's what we're doing. We're buying in a down market. We're rewarded with a positive rental amount. So cash flow positive. You literally have to do nothing. The builder's taking care of everything. So we're buying in a down market. We are seeing positive signs in the Calgary market, which I've discussed with A, we have the completion of the Trans Mountain Light pipeline. B, I don't even really care about that much because I'm more bullish on the tech sector. The diversification of the tech sector that's happening in Calgary. So you're basically paid hundreds of dollars per month to invest money into this property and then sell it when the market picks up again. That's buy low, sell high. So LJ, awesome. Raising hand, and you got it right there. So yes, no risk really at all. The only risk is, when is it going to go up in value? We're not buying in Toronto, but with all the metrics that I'm looking at in Alberta and Calgary, here's the difference that I'm seeing when I first sold those projects in 2019. So when I sold projects in Calgary in 2019 to my Ontario-based investors, they're like, hey, you know what? This looks really affordable. I'm gonna invest the money out there. Okay. In 2021, what I'm getting now is I'm getting the more established real estate investors. They're going, hey, Alex, we really like investing in real estate. We've looked all over Ontario, like not just GTA. We've looked all over Ontario. We've looked out east in Halifax. We can't find anything good that makes sense. We really like Alberta right now. We really like the upside in Alberta. We're going to be investing our money in Alberta because we see huge upside in the opportunities there to invest in rentals there. So really, we're seeing now, we saw people just taking advantage of the low pricing. Now we're seeing the established real estate investors that say, hey, there's some good stuff happening in Alberta. Someone asking, is it better to invest as a company or an individual from a tax and exit point of view? It really just depends on what your structure is set up. Now, I invest in corporations, but that's also because I have an operating company and I'm self-employed. If you're just a T4 individual, meaning that you just have a regular job and you're paid, you're better off just investing under your own name. But if you are a self-employed individual that has a corporation, you can invest then in corporations. You'd set up a holding company, and we can get into more detail on that. If someone wants to send me an email on that, discussing that. But yes, you can close in corporations. Do you know what the management fee would be after 3 years? Market rate for management is about 10% out there, 10% of the monthly rent. But what I've been telling people is that I've been selling hundreds of units out there. So I'll have bulk buying power when these rental guarantees expire in the various projects that I've sold them in. So I'll have other options for people, and because of my bulk buying power, we may be able to negotiate that down. But I'll have options for people in the future. Yes, if you're buying in a holding company, is there a higher rate for mortgages than buying an individual name? Yeah, they usually charge maybe about some more basis points on that if I'm buying in a corporation. So here's the good thing: you don't need to decide right now. You can decide on closing if you want to close it in a holding company. It's not because you're not closing on it till 2022. You don't need to decide if you're putting it in a holding company today or if you're putting in your personal name. You just sign under your personal name, and if you decide you want to close it in a holding company in the future, you just add the holding company on. That's what I've always done in the past. So you don't need to decide today what you're doing in, so you don't need to get caught in the weeds of, oh, how do I close this property correctly? You can do that later. Any other questions from anyone? As I said, it's recorded. I will put a copy of I will put a PDF of the presentation together. So if it is cut up in the recording, you'll be able to follow the presentation with either on your screen with the PDF of the presentation or print out the presentation, but you'll have that presentation with you as well. And well, thanks for bearing with us with the technology end. No flexibility to down payment is only 10%. So 5% in 10 days, 5% in 90 days, zero flexibility on that. But again, if you are investing in Toronto, here's what it is. It's all about capital allocation. If I were buying a pre-construction in Toronto, you'd need minimum $100,000 in the next 365 days. Here, you only need up to $39,000. And that's if you go for the most expensive unit, which is $390,000. That's a 3-bedroom plus den, which could be a 4-bedroom if you wanted it to be. So it's $39,000 in this market versus over $100,000 in the Toronto market. There's no flexibility in the payment structure beyond that. Any more questions? Oh, I do. Let me go to the Q&A. I noticed there's some more building up here. Grant, yeah, there are only 20 units available. Steve, how do we set up a meeting to move forward? Everyone will get an email. They can book a meeting with me to discuss further. Is the whole complex 20 units, or is the builder only launching 20 units? No, it's the complex about 100 units. There's only just 20 units available. Just going down here. Okay. Sorry, again, just dealing with some technology here on the Q&A. I'm just trying to scroll down to get all these answered. Okay, so will it be written rental guarantee? Yes. It's in your agreement when you sign. That is in the agreement when you sign. And here's what it is. Let's say you're like, I don't want this. I don't want the rental guarantee. You have the ability to opt out prior to closing, so you don't need to take the rental guarantee. Okay, yeah, we answered the management fee question. What happens after 3 years? After 3 years, you can just keep on renting it out, and then just pay a management fee, which again, I said it's about 10% of the monthly rent, or we may be able to negotiate that down in the future. What is the rate of appreciation of the property in Calgary? We are buying in a down market, so we're just seeing property increase. We're seeing about a 1 to 2% gain recently, so we're seeing it come up from the bottom. I'm not worried about pricing going down. We're looking at the pricing going up. Do I have to claim the cash flow? Yes, you do. Yes, you do. The government wants their money. Can you put the timeline right, please? When do you get rent? You get rent from day one. Day one. What is the rate of growth of the property? I just look at my whole portfolio and I do a conservative 3% annual compounded growth rate. It could potentially grow more than that. It could grow less. but I just look at a 3% compounded annual growth rate for the property. But I'm expecting significant growth in the Calgary market due to the reasons that I gave before. Looking down, whom should I contact for moving forward? And yes, as I said, there'll be an email going out. You know what? If you're so anxious and you can't wait for the email, in the chat, I'm just going to put my full contact details. If you're on here, you probably already have my contact details. But in case, for whatever reason, you don't, sorry guys, again, we're having issues. Just trying to type out. Almost got my email out there to you guys. This is moving very, very slow. But as I said, I'm just sharing my email with you here on the chat, and then we'll wrap everything up. Everyone will get a copy of the presentation and next steps. So basically, here's the next steps. Get an email out, get a copy of the presentation, the units that are available. You can book a meeting with me. If you're like, I don't even need to book a meeting, I want to jump on this right away, there'll be a suite request form. You fill out that suite request form. That automatically goes to me. Unit will be confirmed with the builder. Then the builder will email you a copy of the agreement. You'll sign that agreement, and then you'll enter your 10-day cooling period, which allows you to get the document reviewed by a lawyer, which we actually have it reviewed for you. So that agreement will be reviewed for you. And then during that 10 days, you will send the first 5% to the builder. So in that 10-day period, you'd send the 5% to the builder. And then any questions, any clarifications, we'd be answering that in the 10-day period. On top of that, if you needed to cancel during the 10-day cooling period, easy, you just cancel, and then you're released from the agreement. No problem at all. So I'm just, email is there now. That should be coming through in the chat. And so thank you everyone for attending. If I did miss any questions, you can email me directly. Happy to answer any questions on that for anyone if you email me directly. You know, we've taken up over an hour of your time. So thank you everyone for coming on. We'll be sending that out to everyone. Okay, talk to everyone later. Bye-bye.